Okay, so we are doing part C of chapter 9, and I'm sorry for the delay. I finally got everything organized. I had to end up getting a document camera, so now it's working luckily. Okay, so on page 5 of chapter 9. So what we're going to look at now is contribution of assets to a joint venture. So we have the joint venture, or the JV. We have two venturers. They're like parents. You can have more than two if you want. So there could be as many as you want. And this time, we're bringing assets into the joint venture. So often, because transactions are recorded at fair value, it can result in a gain. In that case, you split the gain between the portion represented by the venturer's interest in the joint venture and the portion represented by the interest of the other ventures. So, like everything else in Chapter 9 dealing with joint operations or joint ventures, you're always looking at it saying, ooh, some of the other ventures' perspective shows that it can be realized or whatever. So it's a little bit different than a parent sub. So it breaks into two pieces. It talks about commercial substance or no commercial substance. So if a transaction has commercial substance, then if there's a gain, you can right away recognize, I can't spell, oh my goodness, nice, the other venture's percentage. And the venture's ownage is unrealized and then realized over time. So that's if the transaction has commercial substance. And in the question, will has commercial substance or doesn't. In 315, you read a bit about commercial substance when a transaction has it, and I don't expect you to know that now. Just generally know that commercial substance means the efficiency or the value of the assets or something has changed enough so that in the future affected. So that's if there's commercial substance. So basically you record the gain in an unrealized contra account, and that's the venturer's percentage. And then the unrealized or deferred gain is amortized, but if there's a loss, you have to recognize it immediately, right? As accountants, generally, we are more conservative, so that's what you would do. Now, if the transaction does not have commercial substance, none of the gain can be recognized unless the contributor receives cash or other assets in exchange. And in that case, we'll just calculate a portion of the gain that can be recognized immediately and the rest unrealized and amortized over time. So let's go through an example. The numbers here are an example, is the information for both example 3 and 4 on the next page. So January 1st, year 1, venturer A contributes equipment. This has a fair value of $700,000. The cost, or really think of the book value, of $200,000 means there was a gain of $500,000. So venturer A contributes that to the joint venture and in return receives $130,000 in cash, and then venturer B contributes X, Y, and Z. During the first year, the joint venture earns a net income of $204,000. Estimated life on the equipment is 10 years. And venture A's who were interested in, they use the equity method to account for its investment. So here is the joint venture's books after formation. So you notice Venture A has a 40% stake, Venture B has a 60% stake. Neither one has control though, because this is a joint operation, so there's a contractual that says they both have control. So just so you know how they got the 570,000, all you do is you take the 1425 times the 40% to get the 570. Or conversely, you take the 700 minus 130 to get the 570, and to get the 40%, you take 570 over 125. Just in case you're wondering how those numbers got there. The key thing is we're going to use these percentages in the example. So turning over to page 6. We're going to start with example 3. So transaction is considered to have commercial substance. So right now, the gain we can recognize is going to be venturer B portion, which was 60%. 40% is going to be unrealized. So let's start piecing the entry together. We're doing the entry just for Venture A, so we are Venture A. So, leave some space for debits and credits. We are giving up equipment. So we're going to credit equipment, and we gave it up at the book value of 200,000. Now, did we get anything for that? Yeah, if you look back at the question, we got some cash, and that was 130. So, we also have a gain to recognize on the equipment. So, we're going to have a total gain of 500,000. So part of that we can recognize right now because there was commercial substance, and that's going to be 60% of it. And part of it has to be unrealized because that is our portion. So 60% times 500,000 is 300,000, and that's the gain. Venture B, they're looking at the gain going, yeah, that's fine, it's two different parties. The unrealized is going to be what's left over, or 40% times 500,000, and that is going to be 200,000. So the part that we're missing is our investment. And you can just fill in the blank for 570,000. Now, if you look back on the other page, you can see it's 570,000, so you wouldn't have even had to fill in the blank. But if you aren't given that balance sheet, that's how you do it. Now, one thing that's interesting to note is this unrealized gain, and I forgot the word gain. So just put that word gain in there. That is actually a contra account or contra asset to investment. So it's not a liability account. It gets subtracted off the investment account. So now we've got to record the entry that Venture A makes on December 31st to recognize a portion of the unrealized gain. So record portion of gain, of unrealized gain. So we're going to debit the unrealized gain. and we're going to credit the gain. And all we're doing is taking this amount of the unrealized gain and spreading it over the 10 years or however many years the life of the asset is that we contributed. So it's 200,000 years, $200,000 over 10 years, which gives us 20,000. So does that make sense? And you're not going to answer me, but that's okay. So hopefully that makes sense. Okay. So just to regroup, here's our entry where we recognized our investment of equipment, the receipt of some cash, and the gain on the equipment, which we split into realized and unrealized, based on percentage ownership because it had commercial substance. Then at the end of every year, we record a portion of the unrealized gain. Now, this is just plain old net income from the joint venture using the equity method. This you already know how to do. We're recording net income. So the two accounts are investment and credit, equity method. And it's 204,000 times the percent the venture owns, which is 40%. So that's 81,600. I forget I'm not teaching you guys. So that's that for example 3. So this was an example where Venture A invested stuff and the transaction had commercial substance. Now we're going to look at example 4 and assume it doesn't. It's the same transaction, but it doesn't have commercial substance. So transaction not considered to have commercial substance. First, we've got to calculate the amount of the gain that Venture A can record. And they can record gain. So they can record part of the gain now. Because they received cash or other assets. Like, for example, they might have got shares in Venture B's company or something like that. So the amount of the gain is going to be this handy little formula. Cash or other assets. And we're going to take it as the balance of the fair or the proportion of the fair value of the contribution. So that's going to give us a percent, and we're going to times that by the total gain. So the percent of the gain we can record now when there's no commercial substance is based on how much cash we got over the whole transaction, basically. So in this case, we got 130,000 of cash over 700,000 of the contribution, the fair value, times 500,000 total gain. So we can recognize 92857 now. So again, it's not necessarily, well, you guys have an open book exam, but just thinking in logical terms, you take the total gain and go, well, there's not really commercial substance. And if no cash had been exchanged, you would not be recording any gain now at all. It would all be unrealized and then you'd amortize it. But this is saying, well, you know, some cash exchanged hands, not a whole lot to make it commercial substance, but some did. So let's take the percentage of that over the whole fair value. That's the amount of the gain we can recognize. So continue with this example where there was no commercial substance on page 7. So calculate the remaining deferred gain. Well, we started with 500,000 and we're recognizing 92857 now, which leaves us with 407,143, and we're going to recognize over 10 years. So, the investment in A's books, identical to the one for the one with commercial substance, just the numbers are going to be different. So, we got cash, 130. We have an investment that we'll leave till later. We gave away our equipment on the books, 200,000, and then we can record some gain and some is going to be unrealized. And remember again, the unrealized gain is a contra. So the key thing is the total has to be 500,000. So on page 6, we said we can recognize 92857 from page 6. And the remainder goes down here as 407,143. And again, we can fill in the blank for the investment or just look at the balance sheet since we have it. Bear in mind, most questions you won't have the balance sheet, so you'll just fill in the blank, and that's going to be our entry. Now, one thing I do want to say, with these unrealized gains, amortization is actually optional. In this course, we'll just assume you're going to amortize it, but it actually is optional. So, whether it's commercial substance or not. So, amortization of all unrealized gains is optional. Okay, but assume we amortize, unless you're told otherwise. Okay, so now we get to the end of the year, and just like we did on example 3, at the end of the year we're going to do 2 entries, one for gain. And since venture A is using the equity method, we're going to use net income for equity method. So we're going to amortize the unrealized gain, so we debit unrealized gain, credit gain, and that's for 407,143 divided by 10. So it's 40714, 40714. And for the net income, we debit the investment and credit equity method income, just like we did for the other one, for 204,000 times 40%, which is 81,600. Venturer A, who put in equipment on which he had a gain, or she, and it was commercial substance for example 3, non-commercial substance example 4. Either way, there was a gain on the equipment. If it's commercial substance, you can immediately recognize the part of it that has to do with the other venturers, whether there's 1 or 3 or 5. If it's not commercial substance, you have to do the little calculation we did on page 6 to figure out what portion of the gain. Now notice on page 6, if you didn't receive any cash or other assets, what would the percent be? It would be 0. So how much gain could you record right away? 0. In that case, this little entry, there would be no gain, it would be 0, and everything would be unrealized, and then you do the amortization. So hopefully that makes sense to you guys. If not, you guys, you know you can always email me. And I'll leave off this video for right now and do another for Section D.